Hi, everybody, and welcome to our second quarterly investor call of 2023, and thank you for joining us today. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, and then clicking on the Quarterly Investor Call. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or YouTube channel to view the recording of this call or any previous calls.
Well, thank you, Carly, and good afternoon, everyone. Thank you to those of you attending this live presentation, and thank you to those of you who are tuning into the replay. Peter and I are presenting today, and my plan is to discuss some of the economic realities of our world right now and address the heightened level of concerns we are hearing from investors. I'll also talk about what's happening in the US equity markets during the first quarter. We had a serious shakeup in the banking sector, and those implications continue to have an impact on the Federal Reserve's policies. Our focus, as you would already know, is to look beyond the short term and find the path forward to long-term results offered by ownership of great businesses. Today, my comments will focus on the dividends we receive from these businesses and the role of those dividends in our mission to create lifestyle sustainable income from our portfolios in retirement. Peter has compiled an interesting reflection on two of our investments that were byproducts of the global financial crisis in 2008 and 2009. He'll discuss the differences in outcomes for Fannie Mae and Bank of Ireland and provide updates on each of these holdings. Finally, you may know that Peter has been a student of the future for the last decade. The implications of artificial intelligence continue to expand, and the investments we've made in this technology continue to be some of the best performing companies in the world today. Peter will share his personal perspective and provide updates on our firm's course of action with these major holdings in our portfolio. Finally, we'll address the questions you've submitted prior to this call, and then open the lines up to address any additional questions that you submit in the chat box during our remarks. Since we last addressed you on this call, the world has become a seemingly more dangerous place, and investors appear more concerned about global instability today than they have been in years. The chart I've shown on the screen is a visualization of the International Monetary Fund's World Uncertainty Index. The chart consolidates the main drivers of global uncertainty and visualizes them graphically. Looking back over the last 5 years, in 2016, uncertainty jumped following the United Kingdom's unexpected vote to leave the European Union. And then it went even higher after the surprise outcome of the 2016 presidential election in the United States. This was followed by US trade tensions with China, which caused major uncertainty for the world, and trade concerns were replaced in 2019 by the pandemic concerns of 2020, and then those concerns were replaced by the invasion of Ukraine by Russia in the last 12 months. The point is that the cause of uncertainty is constantly evolving, and this chart is useful because it visualizes how quickly sentiments can shift. Today's dominant cause for concern may quickly be replaced by the next major episode of uncertainty, and it's impossible to predict what crisis is looming in our future. So rather than get caught up in the sensationalist reporting of these episodes, our team attempts to stay current and level-headed so that we can keep our focus on finding businesses that have enduring economic value and that will prevail no matter what happens in the world around us. So, of course, we will be surprised at times. And if we own a basket of different businesses with decidedly different risk factors, we can take these surprise moments to act opportunistically instead of being seized by panic. I thought it'd be helpful to provide a brief perspective on the current day conflicts that are creating this rising sense of instability in our world today. In Europe, Russia's aggression towards Ukraine exposed the vulnerability of Europe's economic and energy dependence on Russia. Russia is one of the largest suppliers of energy resources, particularly natural gas, and this has led to concerns among the European countries about their energy security, and it threatens the stability of the global economy because the European Union is such an important player in global trade. Furthermore, Russia's alliance with Saudi Arabia has created an expanded oil cartel, and their combined interest to limit the supply of oil is putting upward pressure on the price of oil around the globe. Higher oil prices have the effect of lowering the expected economic growth around the world because higher energy costs raise the cost of other goods due to the increased cost to produce them. So the concern today is higher oil prices are contributing to inflation and increasing recession concerns. Across the world, China's continued aggressions threaten peace in the Asia Pacific region, which is critical for global trade. A long time ago, Taiwan once was part of China, but after a civil war, the Nationalist Party, who lost that war, fled to Taiwan and established their own government there. China believes that Taiwan should be under its own control, while Taiwan wants to remain independent and have its own government. Lately, China's increased its threats and military pressure to try to influence Taiwan. The United States has interest in Taiwan remaining independent because of our commitment to democracy around the world, and because Taiwan is a major economic and strategic partner for the United States, particularly in the semiconductor space. And as we all saw during the pandemic, global supply chains are very dependent on the stability of the Asia Pacific region. The world's largest manufacturer of semiconductors, or computer chips for layman's terms, is Taiwan Semiconductor. Today, 60% of the world's chip supply is produced in Taiwan, and over 90% of the most advanced chips are produced there. So efforts are being made to move a large amount of this production onto US soil, but the costs of doing this are continuing to increase, and the project is not expected to finish until 2024. And this current situation is creating a standoff between the US and China. We've seen aggressive corporate actions taken by each country towards one another. And while oil still has its importance on geopolitics, it would appear today that semiconductors are the more valuable resource. Here on US soil, the stability of our financial system was put into question in a way that we haven't seen since the global financial crisis in 2008 and 2009. In March, the 16th largest bank in the United States failed, causing a raid on deposits across US regional banks. So as you can see on the slide, US bank stocks responded by dropping nearly 30% following the closure of Signature Bank and Silicon Valley Bank. And the unfortunate truth in this scenario is that these failed banks had previously been warned on several occasions about the risks that ultimately led to their failure. These events put unneeded pressure on the already stressed Federal Reserve, who now has to reconsider interest rate increases and the impact they might have on long-term holdings at these banks. Meanwhile, inflation is at elevated levels that are unsustainable and will have a devastating impact on the poor and elderly members of our population. The knee-jerk reaction from regional bank depositors and investors in those regional banks was understandable, but not rational in our opinion. Most banks did not carry the high levels of customer concentration to a single industry, as was the case for Silicon Valley Bank. The banks we hold in our portfolio, M&T Bank and Bank of Ireland, which Peter's going to discuss later, are very different than these failed banks. There's no question here, though, there are plenty of legitimate concerns in our world today. But there are some bright spots. For the first time in over 40 years, we saw a sustained reduction in M2 money supply, and the efforts to tame inflation are starting to take hold, and prices are slowly starting to normalize. Our US dollar remains stronger than it was for most of the last 50 years, and today, banks hold $3 trillion in reserves compared to exactly $0 at the onset of the global financial crisis. So to shift from the economy to financial markets, tightening monetary policy, a weak economy, high inflation, and rising interest rates all took their toll on the markets in 2022, and that sent stock prices into deep undervalued territory. In the first quarter, though, we saw stock prices surge in January coming out of this deeply undervalued market. And the chart that I have up on the screen shows the relative price to value of stocks going back to 2011. That black line across the middle indicates a fairly valued stock market. And when the blue line is above the black line, stocks are considered overvalued. When the blue line is below the black line, stocks are considered undervalued. Today, the market appears to be undervalued, but this is no guarantee that easy gains are coming in months, because all these issues I discussed on the earlier slides, investors are still in for a bumpy ride, in our opinion, because of the uncertainty. It does appear that the Fed is either at or close to the end of tightening monetary policy. Inflation rates are continuing to drop off, and long-term interest rates have topped out, but our economy still must absorb some of the prior actions taken by the Fed, which could mean slower growth or even a recession later in the year. So for us as investors, we need to keep that long-term focus and keep our attention on the things we can control, not on the ever-changing geopolitical climate or the short-term impact of fiscal policymakers. And one of the areas that I wanted to talk about today that I find helpful to focus on during times like these is dividends. So dividend investing probably seemed downright dull over the last decade. Growth technology companies, they dominated market returns, but today, boring is looking a lot better. With growth starting to slow and the cost of capital rising due to increased interest rates, we expect dividends to be a more significant and stable contributor to total return going forward. The chart that I have up on the screen shows the attribution of dividends to total returns over the past 9 decades. Dividends accounted for only 16% of total market returns in the 2010 decade, but historically, the average has hovered around 38%, and it peaked at 72% during the inflationary 1970s. So let's take a look at last year to see a great example of why dividends are a powerful component of your long-term retirement plan. 7 of our top 10 holdings increased their dividends in the first quarter of 2023. And Peter and I were talking before this call, that's the highest percentage we've ever seen in a single quarter. And our experience was no different from that of the overall market. Despite a nearly 20% decline in 2022, the S&P 500 managed to pull off an incredible feat. In 2022, the dividends across the entire index increased just shy of 11% from 2021. Now, for retirement investors, this is not a minor detail. In a year where inflation was up 6%, the market was down 20%, dividends increased by 10.8% across the S&P 500. And it was the 13th year in a row that dividends went up and the 11th consecutive record high. The 11% increase last year, while it was higher than average, it was not a fluke. The chart I have on the screen tells the story of what's going on here. Very simple. The dividends of the S&P 500 went up because S&P earnings went up. And this is the entire story for retirement investors continuing to own stocks. Rising earnings means rising dividends. Over the last 50 years, since 1973, the index went from 98 to 3,893 at the end of 2022, a 39-fold increase. The dividend of the index rose by more than 18 times. Now, for the important part, the US Bureau of Labor Statistics Consumer Price Index increased 6.4 times from 46 in December of 1973 to 293 in December 2022. Now, I know for a fact that mainstream financial media failed to report on this massively important fact. The tortoise beats the hare is not the type of clickbait headlines that sells more advertising. But for you and me, it's the most important thing. For our pre-retirement savers who are judiciously depositing funds to their retirement accounts to save for the future, a significantly increased stream of dividends means you're investing more at significantly reduced share prices. That's the beauty of compounding. And for our retired investors, it's how their increased income managed to stay ahead of the inflating living costs. CPI inflation at 6%, it's not pleasant, but it's nowhere near the 11% pay raise equities provided. And that's the good news that I have to share for today. With that, I'm going to hand it over to Peter to share some portfolio updates now. Peter?
Thanks, Justin. Today, I'd like to discuss two of our investments that were both negatively affected by the 2008 global financial crisis. Today, the economy and banking sector show little resemblance to 2008-2009. As Justin explained, banks are much better capitalized businesses today, even despite recent events. The two businesses I would like to talk about are Federal National Mortgage Association, also known as Fannie Mae, which insures the U.S. mortgage market, and the Bank of Ireland, the oldest bank in Ireland, founded in 1783. Let's first discuss Fannie Mae, where we have investments in both the common stock and several issues of preferred stock. Fannie Mae is the largest insurer of mortgages in the United States, and it guarantees make the 30-year mortgage possible. Fannie Mae purchases mortgages from banks and mortgage brokers and then packages them into securities and sells these securities to investors, enhancing the liquidity and stability of the mortgage market. Prior to the financial crisis, institutions violated the strict credit checks and standards of sound mortgage lending and sold these toxic mortgages to Fannie Mae. Ultimately, this led to a decline in the U.S. housing prices and an explosion in mortgage defaults. As the defaults on these mortgages grew, Fannie Mae's losses skyrocketed and finances weakened, resulting in the need for massive financial rescue from the U.S. government to remain solvent. Fannie Mae was placed into conservatorship on September 6, 2008, and received over $100 billion in U.S. government loan guarantees in exchange for an agreement to pay interest on these loans, repay the principal, and issue an option to the U.S. government to own approximately 80% of the business. After the bailout loan agreement was amended in 2012 and required Fannie Mae to stop paying interest, but required Fannie Mae to send all the profits to the U.S. Treasury in perpetuity in what is known as the net worth sweep. Now, Fannie Mae has paid the government approximately $180 billion. However, the U.S. government still does not agree that they've been paid in full. On the positive side, beginning in 2016, numerous administrative changes began to be put in place that will ultimately privatize Fannie Mae. The most significant amendment took place in 2019 when the agreement was amended to allow Fannie Mae to rebuild capital reserves rather than sending profits to the U.S. Treasury. Fannie Mae's capital at the end of 2022 was $61.3 billion, up from $6.2 billion at the end of 2018. However, the company is required to build capital to over $168 billion before they will be released from conservatorship. I have read and reread the Congressional Budget Office report issued in 2020 entitled Effects of Recapitalizing Fannie Mae and Freddie Mac Through Administrative Actions. In the report, it gives several hypothetical options recapitalizing both Fannie Mae and Freddie Mac. These illustrations were for 3- and 5-year periods before an attempt to recapitalize. Under both options, the Treasury and the Federal Housing Agency would redeem the Treasury's shares currently valued at about $200 billion. I've also read the Federal Housing Agency's strategic plan for fiscal years 2022 through 26, which was published last April. This report discussed the strategic priorities of building the capital of both organizations. I continue to believe that both the common and preferred stock have significant upside potential when the issues are resolved by the current administration or future administrations, and the businesses, once recapitalized and the conservatorship ends, privatizing the businesses. We've owned Fannie Mae common and preferred stock since 2013, and in the 10 plus years we have ownership, we have losses in the 60 to 70% range. However, I continue to believe that holding and adding to these positions will be well rewarded when the issues are ultimately resolved. Unfortunately, I cannot give you a clear date on the ultimate resolution. My beliefs are not supported by the prices in the financial markets, with Fannie Mae common trading at under 45 cents per share, and many issues of the $25 preferred are trading at less than $2 per share. Who's right? Time will tell. The next business I would like to discuss is the Bank of Ireland. The Bank of Ireland is the oldest operating bank in Ireland. It was founded in 1783 and today is the largest lending bank in Ireland. Bank of Ireland, like many other banks, after experiencing tremendous growth in the early 2000s, unfortunately became over-leveraged. This required the Irish government to bail out the Bank of Ireland and 5 other Irish banks during the global financial crisis. On December 15th of 2013, the Bank of Ireland successfully ended the bailout program when it fully repaid their $6 billion loan to the Republic of Ireland. As part of the compensation, the Republic of Ireland became an owner of 14% of the Bank of Ireland's common stock. After completing the loan payback, Bank of Ireland focused on right-sizing the business, reducing non-performing loans, building a stronger capital base, and restoring the bank's profitability. More recently, the bank has invested heavily in its branch location and technology for its customers. In October of 2017, Francesca McDonough, a senior executive at HSBC, was appointed the new CEO of the Bank of Ireland. In June of 2018, the bank held an investor day to detail 3 medium-term strategic priorities. Among these were to transform the bank, second, to serve the customers brilliantly, and third, to grow sustainable profits. The plan was well underway when 2 events in 2019 and 2020 caused its plan a setback and stock prices to decline substantially and potentially derail the Investor Day plans. The first event took place on July 24th, 2019, when Boris Johnson became president of the United Kingdom, became the United Kingdom prime minister in fears of the Brexit fallout. And the second event was in March of 2020, when the COVID virus hit. The Bank of Ireland had planned on paying a cash dividend. However, when COVID hit, the European Central Bank requested the Bank of Ireland to cancel paying a dividend for 2020. The two events caused the Bank of Ireland stock to be down over 65% and trading at about 20% of its tangible book value. We initiated a position in Bank of Ireland on June 23rd of 2020. Over the past several years, improvements have occurred at the Bank of Ireland. First, the COVID-19 issues have subsided. Second, Brexit was completed. Third, profit margins have improved. Fourth, the cash dividend was resumed and is growing. The fifth, several strategic acquisitions have been completed. And the sixth item, the Republic of Ireland sold its 14% ownership. As you can see from the chart, the bank stock has appreciated substantially from our original purchase. Because of this, we sold a portion of the shares in January of this year to reduce an outsized position in our portfolio. While the stock is not a bargain like it was when we initially purchased it, we continue to believe the Bank of Ireland has a bright future. While both the Bank of Ireland and Fannie Mae were purchased with a multi-time frame, the turnaround has been dramatically different. With Fannie Mae, we're still waiting for a final resolution, while the Bank of Ireland's turnaround has happened almost immediately following our investment. Let me shift gears and talk about a different subject: artificial intelligence. On November 30th, a 2015 startup corporation named OpenAI launched ChatGPT and quickly became a very popular chatbot. It's a search engine like Google, but you ask questions rather than using keywords. ChatGPT uses artificial intelligence and has sparked competition in internet search for the first time in over a decade. As you can see on the chart, the rate of adoption of this new technology is staggering. ChatGPT reached 1 million users in only 5 days. Today, the site has over 25 million visits per day. The technology behind all of this is something we have invested in for the past decade: artificial intelligence, or sometimes referred to as deep learning, and it's the ability of a computer to perform tasks commonly associated with intelligent beings, such as visual perception, speech recognition, decision-making, and translating between languages. The development of self-driving vehicles is another example of artificial intelligence. Just over a year ago, I read and recommended Cade Metz's book, Genius Makers. It's about the mavericks who brought artificial intelligence to Google, Facebook, and the world. I highly recommend it for those who want a better understanding of the history of artificial intelligence. We made our initial purchases in NVIDIA a little over 10 years ago and began discussing artificial intelligence on our calls in 2015. So artificial intelligence is not a new topic for us. With all the hype about artificial intelligence, the common stock of NVIDIA is up over 85% this year. Despite all this good news, we've been examining reducing our large position in NVIDIA in many of our clients' accounts. This is due to the excitement surrounding artificial intelligence and the extremely high valuation of the price of NVIDIA's shares relative to the metrics we use to evaluate our investment purchases. Among these are NVIDIA's price to revenues at over 25 times, price to earnings at over 85 times, price to cash flow at over 55 times. It's difficult as a steward of your wealth not to reduce our position when we can purchase many great businesses at substantially lower valuations than NVIDIA. Among these businesses are Qualcomm, M&T Bank, Berkshire Hathaway, BGC Partners, Warner Brothers, and many others. We'll continue to keep you abreast on our thoughts and welcome your thoughts as well.
Thanks, Peter. Now we're going to move into the question and answer portion of the call. We did get one question ahead of time, but if you'd like to submit a question during the call, you can go to either the chat or the Q&A feature and submit a question, and we'll read it off and answer it. So the first question we got is about the Silicon Valley Bank situation and if that has any impact on our portfolio.
So I'll start with that one, Carly. The comments I made during the call, I think, addressed this, but let me just go back to those. The impact was definitely felt in the shock to the price of U.S. regional banks, and for us, that includes our position in M&T Bank. The risk factors that led to the failing of Silicon Valley Bank and Signature Bank are completely different, and namely where that comes into play is in customer concentration. Silicon Valley Bank was very unique in that it really served the needs of two types of businesses: life science businesses and technology startups, which shared a similar trait in that they were primarily backed by venture capitalists. And what ultimately had happened, and I said these banks had been warned, they had been warned for 6 consecutive quarters by the California Fed that they were taking on too much deposits and that they have to apply those deposits to, in some cases, long-term investments, mainly treasuries, which had been impacted because of the rise in interest rates. So if you own a treasury bond and interest rates go up, the price of that bond goes down. Most of the time, this doesn't matter to a bank because they get to hold that treasury till its maturity and they get their full dollar amount back. But when customers come to collect their deposits, and if they come in droves, they have to cash out those securities at current market prices. That's exactly what happened that got Silicon Valley Bank and Signature Bank into the hot water that they were in. So let's compare that to M&T Bank, who's been criticized for a long time for being ultra conservative. M&T Bank has a very diverse customer base, and it would be very unlikely that there would be a bank run on deposits to M&T Bank. They do have some exposure to long-term treasuries, but their portfolio from a risk management perspective has been managed entirely differently. So the answer is there's probably other banks out there that have these exposures that we don't own. They're definitely out there, but it does not appear to have any immediate impact on our portfolio other than we experienced that knee-jerk reaction of people selling off for the entire sector. You guys, Don, Peter, anything you'd add?
Anything to add? This was terrific. Thank you.
Okay, and Jacob asked what the name of the book you recommended, Peter. That was Genius Makers, correct?
Yes.
Okay.
And the author is Metz, M-E-T-Z.
All right. I don't see any other questions at this time, so we're going to mute the lines. And if you guys have any questions to submit, just use the question box or chat, and we'll answer those for you. We'll stay on for a few more minutes here. All right, I don't see any other questions coming in, so we're going to wrap up the call for today. This ends our quarterly investor call for today. And as a reminder, you can send in questions you'd like answered by our team via email prior to these calls. You can email any member of our team with your questions, and we'll be sure to address them. Thank you for tuning into our commentary on the market and your investments. You will be able to replay a recording of this call within 24 hours on our website, and you'll also be receiving an email with a link to the recording.